Welcome to the Fear and Greed Business Interview. I'm Jennifer Duke. The last few years have seen a sharp increase in the number of Australians investing in shares. It really started during the pandemic when a lot more everyday investors joined the market. It's not surprising then that demand has increased for ways to track your investment portfolio, to monitor performance, track dividends, and make better decisions. One of our supporters here at Fear and Greed is Sharesight, which has been doing all of this for more than 15 years. As a result, they've also got some terrific insights into what investors are buying and selling. Remember, this is general information only. You should always seek professional advice before making investment decisions. Doug Morris is the CEO of Sharesight. Doug, welcome to Fear and Greed.
Thanks for having me on, Jen. I appreciate it.
So I mentioned before this big influx of traders getting into equities for the first time. What did the pandemic mean for a business like Sharesight?
Well, very kind of roller coastery, I would say. I mean, we were sort of wondering what it all meant when the pandemic hit our shores down here in Australia. And certainly we saw the market respond very negatively to where, basically fell off a cliff in the matter of a few weeks, beginning in the US and then cascading down here. But then all of a sudden, what we saw was something very unexpected, which was, sort of the trading volumes and the retail participation in the share market just go through the roof. And as a result of that, the entire digital space kind of came alive, right? So everything from online brokers to research houses to applications like Sharesight, all of a sudden this big international spotlight was shown on what is, in the grand scheme of things, a smaller, more niche industry.
It was a pretty amazing time. What do you think it was about COVID that encouraged people to get more into investing?
I guess just boredom and a bit more cash in your pocket, And it's sort of like a lethal combination of you're locked inside, you've got the NBN, and you've got a few extra dollars from the government or from the fact that, we're not going on holidays and spending our money at restaurants. And I think it was really that simple, to be honest with you.
It's that European fund going into the stock market. Is that what you're saying?
Yeah, exactly.
I mean, obviously, the pandemic affected everyone similarly and differently depending on where you were and what kind of lockdowns you were in. But do you have any thoughts on the sorts of people that started investing for the first time and what they were buying?
Sure. Yeah. So what we saw at Sharesight was kind of a continuation of the customer type we've always served, which is sort of higher end, more experienced investors, and also I would say diligent sort of new investors looking to kind of, do the research and kind of get into the market for quote unquote the right reasons. But then what we saw sort of in April of 2020 was a surge in a new customer type. And that was mostly younger people who were flocking to tech stocks and crypto investments. And their sort of portfolio sizes weren't very large because they were new investors, but they were trading a whole heck of a lot in comparison to our more traditional customer types.
And obviously with that huge amount of activity, and I'm assuming they're using sort of multiple trading platforms and crypto, and it can be pretty confusing. Do they need somewhere to sort of track that overall position? Is that the kind of value that you're adding to that experience?
Yeah, indeed. So what we do is we provide a way for customers to aggregate all of their information because most customers use more than one online broker. And when you do that, your record keeping gets really, really messy. So we're used to sort of a world that operates pretty seamlessly on our iPhones these days. And that's kind of not the world of share market investing. It's pretty ugly in the back end, the plumbing, if you will. And so we bring all that together and then we show people how they're actually going. So we provide performance reporting, some analytical reporting, and then we do the tax reporting as well. And so that's kind of our traditional use case and kind of what we focus on. But what happened during COVID was we had this influx of all these new investors into the market. And actually, most of these customers were using online brokers for the first time. And so they tended to use one broker. And so for us, it was more of an education sort of effort, which is to say that, look, if you're trading on your phone, as most of these customers were doing, you're probably going to get very basic, if anything, in terms of performance. They'll probably show you, what you purchased the investment for. They'll show you what today's price is. And there's just a basic calculation between today's price and what you purchased it for. And that's definitely not performance. You need to take into account, how long you've held the investment. You need to take into account any dividends or what's known as corporate actions, money flows in and out of that investment. And so really for us, it became educating these people around, hey, you really need to stay on top of your performance tracking. Oh, and also you're going to have a tax liability most likely come 30 June of the following year, because I think a lot of the investors were unaware that, buying and selling creates, both CGT implications and also potentially taxable income implications on dividends and distributions as well.
Stay with me, Doug. We'll be back in a minute. I'm speaking to Doug Morris, CEO of Sharesight. Do you tend to see a bit of a spike around that tax time period of people signing up to Sharesight?
Yeah, we do. So June, July, August, all the way up to the filing deadline in October is a very busy season for us here in Australia. And it's interesting because it doesn't necessarily spur more investment decision making, although it can right around that 30 June, 1 July period if people are looking to sort of take advantage of any tax losses, for example. But the nature of a subscription business like we are is that you get those kind of patterns baked into our business. And so kind of every year we kind of repeat that pattern through time.
And I think it's sort of interesting because a lot of people don't tend to think about tax right up until they start getting the alerts from the ATO. If you sort of sign up later, does that include all the data from across the years? And how does that work on the back end? Are you sort of collecting information from all the main brokers here and around the world and importing the data?
Yeah. So we support hundreds of brokers now. So what that basically means is you can join Sharesight at any time, and you can go back, in the case of the ASX, back to 1998 in terms of the data we have. So if you have trades sitting on a platform, say, ComSec or whomever, from, say, the mid-2000s, you can pull those into our software, and then we'll track all your ongoing trades as well. And you can do that with up to as many brokers as you'd like. And we try to make our system pretty flexible. So, you can sign up for free, give it a go. You can add some trades. You can delete the portfolio, give it another crack if you'd like. You can really kick the tires to kind of see how it works. But yeah, we sort of operate in a time-shifted world, you might say, where you can go back in time and recreate your portfolio. You can see how you performed. You can see what your tax implications might have been. Or you can start fresh from today as well.
There might be some people that don't want to look backwards at their performance for some of the recent periods.
That is true. It's quite interesting, actually, Jen. I mean, we've been around officially since 2008. We've been in Australia for a bit shorter than that, 2011, 2012 or so. But in that time, if you actually map the performance of the ASX 200 or the S&P 500, I mean, Sharesight's essentially lived in a bull market for its entire existence up until recently. And what we're seeing really is that people are sticking around because there's more volatility. There's a lot more uncertainty than there ever has been, at least in our lifetime as a business. And I think, we provide that assurance and provide that, real-time look as to how you're going, which not only has implications for, whether or not you're going to make any money or not, but also for tax time as well.
That's a really good point. We are entering this sort of unusual period that a lot of investors won't have experienced before. Do you have any thoughts on what the big investment trends might be over the next year or so?
I really don't. I honestly feel, and this is my own personal take, I feel quite uncertain as to what's about to happen around the corner. It just feels a little too quiet out there. I mean, there's been some interesting analysis done around the fact that, yes, the market is performing better, and it's sort of the usual suspects that are driving that performance, the big tech companies in the States. I think it's like, 7 companies in the S&P 500 are driving like 60 or 70% of the performance, which is the definition of concentration risk, I suppose. So I don't know. I mean, there's a lot of enthusiasm at the moment about AI and the chip makers supporting the AI boom. But there's still a lot of macroeconomic uncertainty. There's a lot of uncertainty still around what the heck's going to happen with interest rates, what's going to happen with geopolitics, the U.S. election. And there's this interesting analysis done around the fact that, markets are doing better, but there's a real tightening of spreads in sort of the day-to-day performance. And so the market might go up or down, but the volatility has actually kind of been taken out of the market. And a lot of retail investors, sort of mom and dad investors, are sitting on the sidelines. And what they think is happening, they being, people who track this stuff, is that actually it's a lot of the large pension, superannuation, and quantitative funds out there whose algorithms are just kind of doing their normal thing and rebalancing and so forth, kind of keeping the market on a steady course. So I wish I had a crystal ball to answer that, but I really just don't know.
It's fascinating, isn't it? I mean, none of us would be in full-time jobs, I think, if we knew what the market was going to do tomorrow. So
that's right. I will say, we do publish top 20 trades by region and by stock market, and we are seeing very, very, very heavy buying. So we track buys versus sells, and we're seeing very, very, very heavy buying across some of the bigger name ETFs, in addition to those tech stocks that I mentioned.
That's very interesting. I did notice in the statistics, we saw some info from Sharesight ahead of this chat. And in those stats, there was a lot of index investing going on. And I was curious if that's sort of the financial independence retire early crowd creeping in a little more, or who might be kind of driving the indexing at the moment?
Yeah, so ETFs are fascinating. So ETFs are, essentially when I joined Sharesight 10 years ago, ETFs were, 3-4% of the trades by sheer volume on our system. So the trades that we process, we track. Now they're about 20% across the user base. And we see kind of two camps in terms of use cases. We see, as you mentioned, that fire crowd, or the newer investors. We see them using ETFs as a way to get started in the market. And that's something that I tell people to do. Like, look, if you want to get started and you're not sort of intimately familiar with any kind of company or industry, consider an ETF, because it's a great way to get going. And obviously, it is a more diversified and you might argue safer approach. But where we've always seen ETFs used amongst our more experienced base is in that core satellite approach. And so people might build a portfolio that is comprised of sort of half of the assets in ETFs and sort of a bedrock style, and then the other half of the portfolio is individual stock picks. And that's something that I do, for example, myself, where I kind of keep around half of my assets sort of autopilot ETF program, and then I make individual investment selections above and beyond that. And I got to say, like, something I've noticed is my portfolio is rather tech heavy. I am the CEO of a tech SaaS company, so I guess that comes with the territory. Got to eat my own cooking, so to speak. But I did quite well. I outperformed certainly over the past 8 or 10 years. But my benchmark that I apply in Sharesight is a diversified ETF from Vanguard. So it's essentially a balanced fund in the form of an ETF. Right? And what I've seen, if you compare those two lines, my portfolio is certainly outperforming for a long time, and it's really receded back, and it's tracking right along that diversified ETF in terms of a benchmark at the moment. So kind of goes to show you that sort of reversion to the mean is well and truly alive.
It's a real thing.
Yeah.
That is very true. Look, Doug, that's all we have time for, but thank you so much for speaking to Fear and Greed.
Thanks so much, Jen. I enjoyed being here.
That was Doug Morris, CEO of Sharesight, a supporter of Fear and Greed. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Jennifer Duke, economics correspondent for Capital Brief, filling in for Sean Elmer. Enjoy your day.